Now today we are going to start a very first chapter, that is evolution of accountancy and basic terms of accountancy. Before we start with the basic terms, let's understand the definition of accounting. Okay, now what is accounting, or you can say definition of accounting. Accounting can be defined as the process of identifying, measuring, recording, and communicating the required information related to the economic events of an organization to the interested users of such information. Now, what this means? This means accounting. What accounting do? First and foremost, it identifies. Okay, then it measure, that means it judge how much it is, what amount it is, it check out the amount. Then after checking the amount, it records, and after recording, the required data is communicated, that means the information is given to whom? To the required user. Now who are the person who are related to this? The accounting of the accountants of the company. Okay, now shareholders of the company, owners of the company, who are they are the one who are related to the accounting information of the firm. So that is what these all people should be given the required data. That means whatever entries are recorded, they should be informed about this. Okay, so this is accounting. See, to understand, I have given traditional definition also, modern definition also. I will read out traditional definition, but we are connected to modern definition. Okay, I'll just read out traditional definition for you. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in at least of a financial character and interpreting the results thereof. Now this definition is being given by the American Institute of Certified Public Association. Okay, now we will go to the modern definition. Now what is modern definition of accounting? Accounting is the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users of the information. This definition has been given by American Accounting Association, that is AAA in short. Okay, do remember, I will read out again. Accounting is the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users of the information. This all I have informed you, I have explained you. That means whatever the judgment we have taken about economic events and whatever recording is being done, that should be informed to the related users. Now who are the related users? They can be shareholders, they can be owners, they can be workers, whoever is related to that information. Okay, they should get the proper information. That is what accounting is. Okay, now let's understand the phases of accounting. Okay, now there are three phases in that. First is bookkeeping, second is accounting, and accountancy. So we will understand one by one. First is bookkeeping. Now what is bookkeeping? It is an art of recording in the books of accounts the monetary aspects of commercial and financial transaction. So what is bookkeeping? Bookkeeping is just a part of making entry of any monetary related aspects. Okay, so simply making an entry of any monetary related aspect is what we call bookkeeping. Fine. Bookkeeping is the part of accounting. It is with record of keeping or maintenance of books of accounts. Fine. Now this is a part of accounting. Do remember, this is not accounting, this is just a part of accounting. Okay, bookkeeping is just a part of accounting. And in that, what you all do? You first and foremost identify. That means you identify the transaction, whether it is monetary terms or just an information. If it is monetary terms, then only you will record it in accountancy. We are related to all monetary transaction, no other transactions. Okay, and events, then we check out even events. That means date wise, whatever recording we do on as per the dates. Okay, then it is measuring. Measuring means the identified transactions and event in a common measuring unit. Now what you do, you check out in calculation way, like 100 rupees, 200 rupees, 1000 rupees, 4000 rupees in terms, okay, in actual terms. So you measure it. Fine. This is your second job in case of bookkeeping. Then it is recording. The identified and measured transactions and events in proper books of accounts. That means once you have identified and measured, that means even you have value what actual value is of that particular transaction. Everything is been done. Now you record it. Okay. We will understand how to record it later. Fine. Just now you understand that you have to record it. Then last is classifying the recorded transactions and events in ledger. Now ledger, when I will explain you ledger, I will explain you how you will classify, because in ledger they have different names. Okay. Now you classify each and every transaction as per the name. Like it is cash account, it is particular a person ka account. Okay. Like my name is Deepa, so it is Deepa's account. So we will classify it as per the name of the account. Okay. So when we will prepare the ledger, we will get to know about this in a much better format. Fine. Now next is accounting. Second phase is accounting. Now accounting is a wider concept than bookkeeping. Bookkeeping was just related to identifying, measuring, recording, okay, then classifying, that's all. But accounting is a advanced, that is next step in case of accounting. Now it starts when the bookkeeping ends. Now as soon as we have recorded, we have classified, all things are done. Now here bookkeeping ends. Now the job of accounting starts. Accounting is an art of recording, classifying and summarizing the financial data and interpreting the results thereof. Now what you do over here? You first and foremost do all the job of bookkeeping. What was the job of bookkeeping? Identifying, measuring, recording and classifying. So this 4 job you have to do. Next is summarizing. Summarizing means in short. Okay, you will not give complete story. You will give information in short. Okay. Then analysis. That means you analyze also, whether it is cash transaction or any other transaction. Every analysis you will do. Okay. Then interpreting. Interpreting, that means communicating. You will put it in a proper language so that others should understand. Interpret it. Okay. And after interpreting, you will communicate it to the concerned user. Okay. So this is accounting. Now let's go to the last section, that is accountancy. Now what is accountancy? Do remember, this is the last and advanced stage. Accountancy refers to the entire body of the theory and practice of accountancy. Now do remember, accountancy is related to theory also, practicals also. Okay, so it is related to both. It is the systematic knowledge of accounting. It explains why to do and how to do of various aspects of accounting. Now it will explain you whole. First and foremost, it will explain why you are doing that. Okay. Then how you will do that. Both the things you will get proper explanation in case of accountancy. It tells us why and how to prepare the books of accounts and how to summarize the accounting information and communicate it to the interested parties. Now it will give you complete information that how you will prepare your accounts, how you will summarize it, how you will give information to the concerned users. Everything will be explained in case of accountancy. Okay, so this is bookkeeping, accounting and accountancy. Now let's understand the basic terms in accountancy. Do remember children, basic terms in accountancy means these words you will come across frequently while doing accounting. Okay, so you should know what actually it means before starting your any numerical or anything. You should know basics of the technical language. So unless and until you understand the technical language of accountancy, how you will interpret it in proper transaction. Okay, so let's understand the technical language. First is business transaction. It means a transaction or events entered into by various parties and recorded in the books of accounts. It can be a cash transaction or a credit transaction. Now do remember, any business transaction which is being recorded by different parties, okay, in the books of accounts, that is business transaction, that is known as business transaction. Now this transaction can be in cash also, in credit also. Now cash transaction everyone can understand. Cash transaction means immediately you have paid cash and purchase the goods, that is cash transaction. Now credit transaction means you have purchased goods right now but not paid for it. You promise to pay in future. Okay, when you promise to pay in future, that is credit transaction. Am I clear? So this is the difference between the cash transaction and credit transaction. Now I have given one example over here. What is the example? Purchase of goods, receipt of money, payment to a creditor, incurring expenses, etc. Now these are what? These are the types of business transaction. Now purchase of goods, that means immediately we have purchased the goods. Now receipt of money, that means we have received money from any purchaser. Okay, so when we have received the money, we will make entry of it. Fine. Now payment to a creditor. Payment to a creditor means we have paid to our creditor. Okay, to a creditor. Fine. So that is payment. That means we have made payment to someone. That transaction also we will record. Okay. Incurring expenses. Incurring expenses, that means you have incurred expenses. So that is all about business transaction. Now what are the characteristics or features of business transaction? First and foremost, it has a monetary value. You have to check out that it should have a monetary value. Unless and until it has a monetary value, it has no use in accountancy, no transaction. Okay. Then it arises cost of transaction of goods and services. Okay, so whatever cost of transfer of goods and services has been arised, that also we have to check out. It affects the financial position of a business. No doubt, whatever transaction we are doing, it will affect the business. Fine. It has two aspects, debit or credit. Do remember, every transaction, whatever we will record, it will be two-sided. Once we will debit it, second time we will credit it. Okay, that means, see, when somebody is purchasing goods, that means we are giving goods and then we are taking money from them, right? So no doubt, when money we will take, we have added in our account, but then we will reduce the goods from our account. Why? Because from our account goods are gone. Okay, so when we will reduce the goods, that means amount of goods will be reduced. So once it is debited, that means added, and once it is reduced, equally, same time. Okay, then next is assets. Now what do you mean by assets? Assets are property, okay, or legal rights owned by an individual or business. There are the economic resources of an enterprise that can be usually expressed in monetary terms. Assets can be classified into current assets, non-current assets. Now what are assets? First and foremost, you understand that assets means something valuable which is being held by you. Like you hold a pen, right? Your parents, they hold a building, car, land. Now what is this? These are assets. Okay, now assets can be of two types. One is current asset and the next is non-current assets. Now what do you mean by current assets? There are the assets which are purchased to convert them into cash within a short period of time. Now what do you mean by short period of time? In accounting, short period of time, that means 1 year. Okay, is it clear? So to understand, if I say short period or I said current means 1 year, that particular financial year. Fine, just keep this in mind. So what they say that current assets means that asset which we can convert it into immediate cash during that particular financial year. Okay, so that is current assets. Now non-current assets. Now anything not classified as current assets is non-current assets. That means anything which is not falling under current assets, that is non-current assets. These are the assets held by the business not with the purpose to resell but are held either as investment or to facilitate business operations. Okay, now non-current assets, do remember these are long-term assets. That means these are being held by the business or taken by the business for any time, if at all any future crisis arises or any time we can use in future for long term. Okay, this can be investment or any type. Okay, now for example, fixed assets such as land, building, machinery, long-term investments, these are what? Non-current assets. Fine. Now even assets are even classified into tangible assets, intangible assets and fictitious assets. Now these non-current assets are classified into tangible, intangible, fictitious. Now what do you mean by tangible? These are the assets which have a physical existence. That means you can touch it, you can see it. Okay, so that is tangible. Now intangible assets. Intangible assets, these are the assets which do not have physical existence. That is, they cannot be seen or touched. Okay, you cannot see it, you cannot touch it. Have you seen copyright? Right. Now what is copyright? Copyright means a authority which is been given to a particular person who has made the design or any content. Okay, so he has taken approval from the government that nobody else has the authority to use that content. If anybody use it, then he will sue the person in court. Okay, now what is this? This is also an asset. Why? Because this is a valuable thing which we possess. Fine, but then these are the assets which we cannot touch, we cannot touch it, we cannot see it, we can just feel it. So that is why it is intangible assets. Now fictitious assets. Fictitious assets, these are unexpired losses and expenditure. These are basically not assets because they do not have a realizable value. For example, deferred revenue expenditure, discount on issue of shares, loss on issue of debentures. Now what happened? These are fictitious assets. Fictitious assets means imaginary assets. Now what do you mean by imaginary assets? Now actually these are expenditure which we have done when we were forming our business, when we were starting our business. Okay, now government give a facility that such kind of expenditure which you carried out before starting off your business or any losses which you bared before starting off your business, now these losses you can reduce from your profit. Okay, in parts. Now when I will reduce that amount from my profit, that means I have saved that amount of profit. Fine. When I have saved that amount of profit, that means I can use that profit in future. So that is why it is known as fictitious assets. Okay, is it clear? Now let's understand the next basic terms, that is liabilities. Now liabilities means the things which we owe, that means which we will pay, the business will pay, we will not pay, the business will pay. Now the business can pay to the owners also, the business can pay to the outside people also, but actually the money will go from the business unit. Okay, so what is liabilities? It means the amount owed, or you can say payable, by the business to outsiders and to owners. Okay, it can be to the owners of the business, but the money will go from the main business. Okay, so that is liabilities. Liabilities to outsiders are called external or outside liability. Okay, or simply you can say it is liabilities. Now for example, what is it? Creditors, bank overdraft. Now what do you mean by creditors? Creditors means the person from whom we have purchased on credit. On credit means udhar. That means I will pay them in future. Okay, so that is they are my creditors. Fine. Bank overdraft, that means I have taken loan from the bank. Overdraft, see, bank overdraft, what that means, that is particular word means that on my account I have withdrawn more than my balance. Do remember, when I withdraw some amount more than my balance in my bank account, that is called as bank overdraft. That is a loan, okay, that we have to pay, or you can say business have to pay. Now liabilities to owners are called internal liabilities or simply capital. Now I told you two types of liabilities are there. One external, that is outsiders. One, the business will pay to the owners of the business. Now if there is some amount which is being payable to the owners, that means it is called as internal liabilities, or even you can call it capital. Capital means what? The money which is being invested by the businessman, or you can say owners. Okay, now liabilities are classified in two parts, that is current liabilities, non-current liabilities. I hope while explaining current assets I have explained you current means what. Current means within 1 year, that is one financial year, that particular financial year. Wherever you see current is related to that. Okay, now current liabilities means these are liabilities which are payable within a year. Okay, now what kind of liabilities are they? They are creditors, bills payable, short term loans. Okay, that means which are payable within a year. Okay, now non current liabilities, anything not classified as current liabilities is non current liabilities. These are payable after a period of more than 1 year. Okay, that is for long time. Okay, now what are the examples? Debentures, long-term loans. Now long-term loans you can understand. Debentures means it is a type of security which is being sold by the company. Okay, it is a type of loan which is being taken from the common public by a company. For after taking that amount, they issue them a legal document. Okay, so that type of credit is known as debentures, or you can say loan is known as debentures. Okay, so that is non-current liabilities. Now next basic term is capital. Capital word is very clear. Now capital is the amount invested by the owner in the business. It may be in the form of cash or kind. In accounting, business and owners are separate and distinct entities. Now we say in business, okay, just now I explained you that business is liable to pay owners also. We can say, ma'am, it's their business. You will say, ma'am, it's their business only, right? But no, in business is different and the owners are different. They are different entities. Entities means two different individuals. Okay, as per law. So whenever the amount is being invested by the owner, that amount is called capital. Okay, so I hope capital word is clear. Hence capital is the liability of the business towards the owners. Fine. So if any amount is invested as a capital, that is the liability of the business. Okay, that means business is liable to pay back to the owner in long term, not in short term, but in long term. Okay, now that is they will be liable to pay towards the owners. In accounting, such liabilities is also called internal liabilities or internal equities or owner's equities. Owner's equity, that is capital only. Okay, that means the owner of the business, whatever amount he has invested, these are the different names of the capital. Okay, sales. Now what is sales? It means sale of goods. Sales are total revenue from goods or services sold or provided to customers. Sales includes both cash and credit sales. When goods are sold for cash, they are termed cash sales, and when sold on credit, they are termed credit sales. Now, sales is a simple meaning whatever goods or services which is being sold by the business to the consumers, that is sales. Okay, now it can be cash sales also, it can be credit sales also. Now, what is cash sales? If it is being sold on instant cash, immediate cash, that is cash sales. Okay, and if it is being sold with a agreement that the amount will be paid in future, okay, whoever is purchasing from us, they will pay us in future, so that is credit sales. Okay, next is expenses. Now, what do you mean by expenses? Cost incurred by the business in the process of earning revenue are known as expenses. It is value which has expired during the accounting period. Now, what that means ki expenses means whatever expenses, whatever liabilities we have carried out while going to earn revenue. Now, when we earn revenue, when we sell goods, right? Now, suppose if we have incurred any expenses while transportation, while production or anything, now that is what? That is expenses. Okay, now if we see, it may for cash payment, okay, that means salaries, wages, rent which is being paid to the workers, or you can say staff members or laborers. Okay, writing off of a part of fixed assets. Now, what do you mean by writing off? That means we are reducing depreciation. Now, what is depreciation? Depreciation means that amount which is being reduced from the asset. Why? Because we are using it. When we use any asset, the life duration of the asset reduce. Okay, in business we reduce that amount also from the asset. Okay, so that is called depreciation. You will come to know about it later in detail. Okay, now writing off of a current assets. Now, what do you mean by current assets? Means the amount which we will receive within 1 year. Okay, suppose if at all, why we will write off? We write off, that means we have reduced. Now we feel that we will not get this amount. Okay, we assume, we presume. Now that is called bad debts. If we presume that we will not recover the amount in 1 year, okay, so that is a bad debts. Fine. Next is reduction in the value of assets. Now, investment, we have invested money, okay, in the market. Now the amount is reduced automatically. Why? The market has gone down, so that may be the reason. So these are what? Expenses. Cost of goods sold. Now, when we are selling the goods, some cost is being incurred, that is also known as expenses. Expenses are of two types, that is prepaid expenses and outstanding expenses. Now, what is prepaid expenses? It is an expenses that has been paid in advance and its benefits will be available in future years. Okay, now we have paid some amount in advance like electricity bill, rent, whatever, but the benefit we will receive in future, that is prepaid expenses. Okay, next is outstanding expenses. Now, what is outstanding expenses? It is an expense that has not been paid in the current year, but the benefit of which has already been availed. Now, we have enjoyed the benefit, but we have not paid for it. Okay, in the particular current year, end of the day we check out that this expenses is yet to paid, that is outstanding expenses. Okay, so this is what expenses is. Rest of the basic terms we will go ahead later.